My name is Daniel Figueredo. I am co-leader of our nonprofit practice at BPM. I will be your moderator for today's presentation. It's my great pleasure to highlight our all-star cast here and our all-female cast of presenters, my great nonprofit colleagues. Starting off with Shannon Winter. She is my fellow co-leader of our nonprofit industry group at BPM and works very extensively with nonprofit organizations on the audit side of our practice. Along with her is another one of our great nonprofit leaders and senior manager, Melodie Olson, who works both in our audit practice and our outsourced accounting practice. Both of them will be covering a lot of the fun updates in the accounting and auditing space today. Along with them are two of my nonprofit tax colleagues. Tami McInerney is the leader of our nonprofit tax team and works significantly with nonprofit organizations as well as high net worth individuals and their foundations. So it's my pleasure to have Tami with us, as well as Elena Serabakova, who is our lead nonprofit tax director, will be also chiming in with a lot of great details of tax updates and a lot of great interesting information that I'm sure you're wanting to hear about related to recent acts of Congress and COVID related updates. So let's jump real quick into the agenda. What we'll be covering for you today, we figured that you're most interested in what is the latest and greatest around COVID-19 as it applies to nonprofit organizations. So we will cover some highlights for you, probably for about the first half of today's webinar. And then we'll get into the more typical accounting and tax updates of new accounting standards and other emphasis areas for taxes in the second half of today's presentation.
In my 28 years, this was the most challenging tax season because it was fluid and ever-changing, and it seems like we had two major tax acts in the middle of our busy season, and constant updates and notices from the IRS and changes in deadlines, and so it was a really interesting year. And every time we would release information, it would change, and so what we're going to talk about today is what we know today, and we're still waiting for guidance on some things. So just in general, it was a crazy year. so Lena is going to talk about disaster assistance.
Good morning, everybody. So I'm going to start with the good news, and it's not on the slides. I just read it today morning that IRS is going through the mail and they're processing the mail. So yesterday, I think there was an update from IRS that they are significantly caught up with notices which are going out. They're working on a mail which they received. So if you sent something 3 months ago and you never heard back, now we have hope that soon they're going to process your mail. They also started processing power of attorneys, because power of attorneys was sitting somewhere as well. So that's good news. We're hoping that not only notices coming out, but they're also reading the responses. And after that, let's jump into Charitable Assistance Program. I think we learned a lot this year about disasters with COVID-19. And in some parts of the countries before, people actually knew more about disasters than others, because in some parts you had fires, in some parts you had hurricanes, maybe earthquakes, but this year disaster is disaster for the whole world, for the whole country. So the question is, can a 501c3 organization provide disaster assistance to people? And this question has two sides. From the federal standpoint, the 501c3 organization does not need to notify IRS that they're going to be providing a disaster assistance to individuals. But also there is a side with the state. And before you do provide the program, if you didn't do it before, look at your state documents. Look at your articles of incorporation. How your charitable purpose is defined. Is it broad enough to include assistance to individual, or it's really narrow? And if your articles of incorporation are really narrow, describing charitable purpose, you might not be able to do the disaster assistance. You need to amend your articles, which probably gonna take some time. But let's assume that 501c3 organization can provide the disaster assistance program. How do you establish this program? First, the program has to assist a charitable class. What is a charitable class? Charitable class should be broad or indefinite. So you cannot just say it's going to benefit people on the main street who live from this house to that house. If you have a really narrow class of people, such as like alumni of the some college or university, it needs to be indefinite. So it needs to be open-ended. You cannot pre-select people. You cannot say, okay, this group of people, we think we need to provide assistance, it's just this group of people. The program needs to be publicized, people need to know about it. You should have an oversight, so it's not only people who may be at the top of your organization, you include other people as well. You also want to make sure that you have a selection committee, and for those grants to individuals, people are selected on objective basis. Then you're gonna think, okay, is my disaster assistance program short-term or long-term? Because depending on timing, you will need different documentation. Next slide, please. The assistance amounts which you give to people have to be based on need. So before giving money to people, you need to ask, does this person, he or she, do they have available cash, some other assets they can sell, and they have access to it? Because people might have some assets, but they cannot access it at this point. You cannot give grants which replace somebody's lost income. So somebody comes and says, okay, my salary was so much, I lost my salary, can you give me the same amount? No, you cannot. You need to look and consider all the facts of the situation. And you need to do it before you give the grant, not after. Because after you gave the grant, you can document it, but it's hard to justify that you considered it before. And of course, if the organization runs a program, the organization has to have documentation. If your program is gonna reach top 1-3 of the programs, you have to disclose it on Form 990. If you give grants to individual in the United States, it has to go to Schedule I. If you give grants to individual outside the United States, it has to go to Schedule F. And for all of that, and for situation where an IRS or somebody else comes and asks some taxing authority or regulation authority about your program, you need to have documentation. So one of the points is, okay, what did you have a criteria to administer the program? Who approves the grant? Was there a selection committee? When and where the assistance was given? So you documented, it was on the day, that's how it happened. Then you keep a tally how many people you provide assistance to. What exactly was given? Did you give hot food? Did you give blankets? Did you give cash for housing? Or did you give something else? Did you have anybody who was related to decision makers? You need to document that too. Or somebody who is related to substantial contributor of your organization. And for the long-term programs, you need to have probably grant application because it's not a short term when you have disaster struck, you have a fire, people come and they don't have food, they don't have money for housing. It's immediate need. Long term usually have grants application, you collect names, addresses, you have a purpose for this grant, you see how it fits into your purpose. And then, of course, all the grants you're given for charitable purposes. You don't want to give grants which can be say, okay, it's benefited specific person, it's this person not of a charitable class. So you don't want to have a situation when you need to justify that. If the organization wants to do the disaster assistance program, it should do it. Just be careful, document everything, set it up as a program, have enough data to reflect it on your 990. There is also question periodically come up, what my employer can do, or I am an employer and what can I do to help my employees? And this program was in place for a while, so it's not new. And under Section 139, employer can provide some assistance to employees. That payment is not included in employee income if some specific criteria are met. Because usually when you give something to an employee, it's compensation. So you would want to structure the program the way to avoid the compensation if you're offering it to employees. There is very specific rules what is a qualified disaster. So it has to be the result of military or terrorist action, a federally declared emergency, and a COVID-19 is right there, is a federally declared emergency. And some people said, by the way it was declared, it wasn't sure if it was qualified, but IRS said, yes, it will. So it's a federally declared emergency. It should be a result by event determined by the secretary to be catastrophic nature, and it could be an event with common carrier, or if not only federal, but state, local authority determines that it warrants assistance from the federal, state, local government. Next slide, please. So we have to look at the program. Again, as we talked before, the recipient have to be selected based on objective basis. It's better when it's gonna be by independent selection committee. I don't know if all the employers can provide it, because if you're a small employer, it's hard probably to have independent selection committee. You cannot replace lost wages. So you cannot replace the amounts which are paid by insurance. So if you have a hurricane and your house lost a roof and insurance says, okay, we're gonna cover cost of the roof, employer cannot pay for the roof. But if somebody lost housing and somebody needs transportation, and there was a disaster which is declared by the president, you can pay for that. It also can be, the payment can be for repair of personal residence, replacement of personal property in a personal residence. Payments needs to be, they need to be reasonable. You cannot just probably give $1 million to somebody to make their house better. You also can pay for reasonable funeral, personal, and living expenses. In a light of COVID-19, it's really hard to determine what expenses you can actually pay, because most people are staying at home. Hopefully they didn't lose their house. They probably don't have transportation because they're not going anywhere. But what if somebody didn't have internet? I don't know if possible, and now you have to have an internet to work from home. Can you say this is a reasonable expense? So you need to look through your expenses. Maybe medical expenses, if they are not reimbursed by insurance. But you need to make sure those are not reimbursed by insurance. Next slide, please. Section 139 expenses, they do not require to be documented as you do it in accountable plan. However, employer has to ensure that amounts of payments are reasonable and they are in relation to expenses incurred. One of the practices is the employer can ask an employee to sign a document which will say that this is the expenses I incurred, and they do qualify under this section 139. In this case, probably employee should know what qualifies under section 139. They also should say, yes, these expenses which you're paying for, I'm not getting reimbursed by something else. Nobody, such as insurance, gonna pay for those expenses. You don't need to ask for the proof, so there is no checks, and sometimes it's not possible to get the checks if the disaster strikes. But remember, the expenses have to be reasonable. So employer has to document it and keep it on file.
So just to follow up on that, the 139 plan, you know, a lot of organizations and companies who didn't have this type of plan in place weren't able to get it in place in time to help with this particular disaster, but it's a good reminder that, you know, we in California have other disasters where our employees can be affected, you know, like the North Bay fires was one, and if we have a major earthquake. So it's a good time to think about establishing some sort of plan for future disasters. So we are going to talk a little bit about the CARES Act, and we're focusing here on things that affect nonprofit organizations. So because there were a lot of tax law changes that occurred in the last few months, but we started the year in a very positive note in the nonprofit world, and that was they repealed in December of 2019. They repealed the inclusion of the qualified transportation benefits and parking expenses, and that was the you know, a lot of nonprofits suddenly had to start filing a 990T to pay tax on this on their qualified transportation benefits and parking, and there was a big you know, upset in the nonprofit industry because it was sort of an unfair tax on nonprofits. So they did repeal that, which was great news to us. And so we started out the year with that, and we've been amending 990Ts for those that did pay that. And on the dark side of that is then COVID happened. So a lot of those 990Ts, which are paper returns, the amended returns, you know, being very slow to be processed. So that's going to take a while. So if you're an organization that has paid some of that tax, then you know, you can file a 990T amended return and get a refund, but it's going to take a while before you get that tax back. One of the other changes from December was private foundations have a 1 or 2% excise tax that they're subject to, and that was moved to a flat tax of 1.39%. And so that took away a lot of the planning for private foundations and trying to get to the lower tax rates. And now there's just a flat tax. It really simplified things for them. So it's one thing that you need to keep in mind when you're paying your estimated tax payments and deferred tax calculations on the audit side. Next slide. So the CARES Act had several provisions that that are great for nonprofits, and we actually had a few more comprehensive webinars on the CARES Act that are available on our website, because we're going to go over some of these briefly, but they were more in depth if you need more information on this. But one of the big provisions was payroll tax deferral, and a lot of organizations are taking advantage of this. And so you can defer payroll tax that you incurred from March 27, 2020 and through the end of the year. And 50% of that will be due December 31st, 2021. and 50% of that will be due December 31st, 2022. So this is a great benefit to all employers, including nonprofits, and so definitely take advantage of that. Originally, they had said you can't double dip this benefit. So if you received a PPP loan or some of the other ones that we'll go over in a moment, you couldn't do the payroll tax deferral, but there was some relief that we'll go over in a few minutes. So next slide. So another benefit is the employer tax retention credit. And this is available for nonprofits and small businesses. So this was a great benefit where you get a 50% credit for wages paid from March 13th through December for eligible taxpayers. The credit is available to employers who carry on a trade or business in 2020 and who experience a full or partial suspension of activity by government order due to COVID-19. So in the qualification is that is if you had a 50% or more decline in your gross receipts compared to the comparable quarter in 2019. So it's really intended to help those that had a big impact. So this is a fully refundable credit that's determined quarter by quarter. The maximum amount of qualified wages taken into account with respect to each employee is $10,000. So there's a maximum credit of $5,000 for any employee. You can claim the credit on Form 941, but if you want a credit, there's a new 7200 that the IRS came out with, and they've allocated extra staff to process these forms to get the refundable credit. You are not eligible for this credit if you're a recipient of a PPP. So there is some no double dipping rules here on some of these benefits. But if you didn't get a PPP, it's a credit you should definitely look into. You claim the credit on the 941 or the 7200. And qualified wages, so if you have 100 or more full-time workers, it's wages paid to employees who are not providing services due to the shutdown. So they are, for the larger employees, they're only letting you take the credit if you had an actual reduction in your operations. If you have fewer than 100 employees, then all your wages qualify for the credit, regardless of whether you had a shutdown, or a reduction in your business. Next slide. So the economic injury disaster loans is something that's been around for a while. So it's not new, but what is new, and it's available to nonprofits generally and small businesses. It was a pre-existing program where they provide nonprofits loans of up to $2 million at a low interest rate of 2.75%, which doesn't seem that low, but it's lower than other SBA programs. But the CARES Act provided a $10,000 emergency loan, which is essentially a grant. And so nonprofits could apply for that loan and get emergency advance funds to meet obligations because of revenue losses, such as payroll, rent, and mortgage payments. The emergency economic injury disaster loan does not have to be repaid if it's used for qualified expenses. However, if the organization applied for and received a PPP loan, that $10,000 emergency grant will get subtracted from the PPP loan forgiveness amount. And that's when you apply for your PPP loan forgiveness, it's on the form. You have to include the amount that you received for an economic injury disaster loan if it applied to you. The payroll protection program, I think most people are aware of this program because there was a lot of press about it and the slow applications. This loan still exists, and the CARES Act expanded the loan and made it available to nonprofit organizations. The maximum amount of the loan is the lesser of 250% of the organization's average monthly payroll for the prior year, or $10 million. And this, this was a popular program. A lot of nonprofits did apply for this and receive it. And the loan is forgivable to the extent that it's used towards qualified expenses. And originally, you had to use 75% of the loan for payroll, but they changed that, and so now you only need to use 60% of the loan. So the original PPP program from the CARES Act was limited to essentially help organizations and companies cover 8 weeks of payroll. And the way the formula worked, it was essentially you had to use it to cover your payroll, and there were certain qualifications, and if you didn't, in order to get the forgiveness, it had to be used during that period of time. And so they passed the Paycheck Protection Program Flexibility Act, people call the Flex Act, and that expanded that 8 weeks to 24 weeks. And it also added a little flexibility so that they reduced the percentage of funds that must go towards payroll from 75 to 60. So that made it a little bit easier for organizations to meet the tests and get that forgiveness. And it changed the deadline for safe harbor on rehiring workers to December 31st. So the new act provided more flexibility. It really made it much easier to qualify for the forgiveness. And it extends the deferral of loan payments from 6 months until the date the forgiveness amount is approved. So the key with these loans is work with your lender. If you have a loan, each lender's approach is a little bit differently, and SBA released information, but working with the lender is the key. And we actually have a group here at BPM that is very closely involved with the lender and the rules and how this works. And we've had a few other webinars that were devoted just to the loans and applying for the loans and applying for forgiveness. So if if your organization needs assistance, reach out. We can connect you with people that can help you through this process. The next slide, Shannon. So one of the things, there's a application to get that loan forgiveness, and it's on the SBA site, so you should work with your lender on that. But there's a short form application and a long form application, and so for those people that need help with that, reach out and we can connect you with people to help, or reach out to your lender. The short form is a much easier process. So NOL carryback. Another change is we previously weren't allowed to carry back NOLs. And so part of the new laws, we can carry back NOLs for tax years after December 31st, 2017 and before January 1st, 2021. So if you have a 990T NOL, it could be carried back 5 years. And, so we had some organizations that actually had NOLs in 2019 that could be carried back. And we expect that 2020, a lot of companies and organizations will qualify for this relief, and then they can get a refund of some taxes they paid in prior years. Those NOL carrybacks will take time to process because of the shutdowns at the IRS and reduced time in the office, but eventually there'll be some, relief for some organizations who paid those taxes. The CARES Act had some charitable contribution provisions. One thing which I don't think will have a great impact on nonprofits, but it'll help, and that is individuals who don't itemize their deductions. And a lot of individuals who used to itemize their deductions now take standard deduction because that was increased with the taxpayer in 2017 with the Act. So now they can take up to $300 above the line. So even if they are standard deduction taxpayers, they can take a $300 above the line deduction to make a contribution to organizations that are needing that help this year. And another thing, they expanded the AGI limitation for cash contributions. And this, historically was 50% of your AGI. So if a taxpayer had AGI of 200,000, they could deduct up to 100,000 under the old rules, and they increased that to 60. And then last year, and with the CARES Act, it's now at 100%. So in theory, a taxpayer who has 200,000 of AGI may be able to deduct cash contributions of 200,000. But there's a caveat, and that is when taxpayers have non-cash contributions, if they donate stock or, goodwill items or goods, there's a interplay of the cash contributions to the non-cash contribution, allowed. So a taxpayer may think they're getting 100% deduction. It may actually not end up being 100% deduction if they had contributions that were not cash. And then this new provision does not apply to donations to donor advised funds, to private non-operating foundations and supporting orgs. So it's generally meant for taxpayers to give to public charities. And another change or relief provided was individuals over 70 and a half were subject to take a required minimum distribution from their retirement accounts every year once you get to a certain age, and those rules have been suspended for this year. So taxpayers who normally had to take their required minimum distributions don't have to do that for 2020. There was also provision that allowed people to repay if they had already taken one earlier in the year. One thing, this will affect charities because I have a lot of individual clients who like to give to charities directly from their retirement accounts, and there was a specific exclusion that allowed them to exclude that retirement income from their personal return if they gave it directly to charities. And I know that was a great source of revenue for some charities. So you may find that people are doing less of that this year because they're not subject to that required minimum distribution payout in 2020 like they normally are.
So Tami just went through and talked about the PPP loans, and I know a lot of questions that we've been hearing is, so what does that mean for my audit and my financial statements? So there has been clarification, and there are two options for how you can be reporting the PPP loans on the financial statements. The first option is following the debt guidance, which is regardless of whether or not your loan is going to be forgiven, you're going to be accounting for that as a liability on your financial statements. One clarification is you do not need to impute the 1% interest, as the governmental agencies are specifically excluded from needing to have imputed interest on their grants that are given to an organization. Then you would be able to proceed the loan as you would be able to remove the loan as it is either in part or wholly forgiven and it's been legally released, or if you pay that loan balance off to your creditor. So once your loan is partially or completely forgiven and you've received that legal release on that liability, you would be recording the gain on extinguishment. And this guidance here is available for both for-profits and nonprofits under the debt guidance. The second option, and this is very specific just for the nonprofit entities who receive a PPP loan. So if you do not record the loan under ASC 470 or the debt guidance, then you would be deeming your PPP loan as a grant that you expect to be forgiven, and you would have to follow the new conditional contribution guidance that is highlighted in ASC 2018-08, which clarifies our grants and contributions. And that is one of the items that we'll be discussing as part of the accounting updates and reminders in regards to nonprofit accounting for grants and contributions. So if you deem this to be a conditional contribution, you can't recognize that revenue until those conditions or barriers have been substantially met or explicitly waived. And you would record the cash inflow as a refundable advance on your financial statements at the time that it is given. And recognize, again, the contribution once those conditions of the release have been met or explicitly waived by the creditor. So kind of highlight, in summary, no matter which option you choose, either the debt option or the conditional contribution, you would be recording a liability on your financial statements until those conditions are substantially met or you receive the legal waiver. Then you would record a gain on the forgivable loan as an extinguishment of debt, or as a contribution as it's been substantially met. And if the important thing to understand is that if your PPP loan is material, you would need to be including a disclosure on your financial statements in regards to what your accounting treatment is and your policy of how you treated the PPP loan in the financial statement.
Shannon, real quick on, we've had a number of people with questions on the PPP loan accounting, and many are 6/30 year end, so they may have already received a PPP loan. Anecdotally, which of the two options do you see out there people considering most? And is it a definitive yes or no in terms of I can book some of it before year end or wait until the application, or is it it depends?
It depends. I have seen both in regards to how they're recording their PPP loans. Well, what I've had in discussions with some of my clients is if they feel at the time that their financial statements are being closed, they've gone through and they've already exhausted the funds and they've started their loan forgiveness application with their creditor, that's where I've seen them leaning more towards the conditional contribution and being able to document that they've substantially have met all of those conditions as they're starting to do the loan documentation forgiveness. I've also seen quite a few that are going with the recording it as a debt and waiting until they actually get that legal waiver that the loan has been forgiven. So it's really going to depend on an individual organization's decision and management. There's no right or wrong answer. There is the option for both. I do know that in the for-profits, more are recording them as the debt, as that is the more conservative approach and the more understandable that it is the debt and you're waiting for that legal waiver that it's been released.
For those of you that have audits, best thing is to make sure to have a discussion with your auditor on your approach as well, so that you can have a good path forward on how to proceed, whether to record some of that as revenue in the year or wait until you have your forgiveness approved.
Then the next question that has been coming up quite a bit is what happens to my special events that have been canceled and we're no longer able to have them? And just a little bit of background, one of the things that we wanted to highlight is that when it comes to special events, you need to go through and understand that a lot of times it's going to be part fundraising activity and partly an exchange transaction. So your revenue for that event may need to be divided between if it's a contribution or revenue from exchange transaction for financial reporting purposes. And the exchange transaction does get measured at fair value. So you may have partly a contribution and partly the exchange transaction revenue. With that, if the event is scheduled after year end, then the exchange transaction should be considered deferred until the event takes place or goods or services get transferred to a ticket holder. And the contribution piece of that is presumed that it is conditional on the event taking place. So it also would need to be reported as a refundable advance until the event takes place or a donor explicitly waives the condition. So if you received money for a special event that hadn't occurred, you would have a deferral or a refundable advance on your financial statements. This is just a little chart that summarizes the kind of decision tree in regards to selling an event to the ticket and whether or not a donor's waive that right to a refund. So if the donors waive that right to a refund, you may be able to recognize that portion of contribution revenue. So if you've had to go through and cancel the special events, the important things to look at is on that exchange transaction piece, reach out to the donors. Find out from your donors how it is that they want that piece that's already been paid handled. You can continue to hold the amount as a deferred liability for hopefully being able to do a future event. You can refund it back to the donor, or the donor could waive the exchange portion and convert the whole amount to a contribution to the organization. And no matter which of these three options you have in regards to the conversation with the donor, you want to make sure that you have a trail for that documentation of the change and understanding the donor's intent. Similarly, on the contribution portion, again, reach out to the donors and try to get that condition that the event had to occur for the contribution to be recorded, have that explicitly waived. And you also want to make sure you obtain the documentation that the donor has waived that presumed condition. The last item in regards to the financial statements, just wanted to highlight some footnotes that are going to be more and more common in the financial statements. And that's a general footnote in regards to operations that have occurred as a result of COVID-19 and how there may be some uncertainty or operations and cash flows may be different in the current year's financial statements and the effects it may have. Another common footnote is explaining if an organization has received a PPP loan and how those proceeds have to be used to cover payroll costs and other non-payroll cost items, and when the loan would be forgiven. And some other items to be thinking about in regards to what's happening is understanding that whether or not there may be additional impairment testing. Do you have goodwill on your books? Can you still utilize that? Do you have assets that you aren't going to be able to utilize anymore of the same life? Making sure that you go through and you update your internal control activity. You know, now that many of us are working remotely, how are your policies and procedures updated, and how are you maintaining those controls while people are working remotely? In regards to the audit opinion, there may be some audit reports that have an emphasis of a matter specifically regarding the impacts or the shutdown of operations or changes of operations in relationship to COVID-19. And what does your financial statement picture look like in the going concern? And that going concern is 12 months from the date that your audit report is issued, not the end of your fiscal year. So many times you're really looking 18 months out from your financial statements. So the next section is, what does all this mean if I also receive other federal funding in a COVID-19 world? So there was some new guidance that just came out. The first item that I want to highlight is they have clarified that if you've received a PPP loan, that will not be subject to the uniform guidance or single audit requirements. There are other grants from the SBA and the emergency disaster that could qualify you under the uniform guidance, and it's very specific in regards to what type of grants and where that funding comes from. So the largest question is, what does this mean in regards to double dipping? There has been clarification that if you received a PPP loan and you charge payroll against it, you cannot charge that payroll and those other allowable expenses on the PPP loan to other federal grants, because that would be considered double dipping. So you would need to go through and make sure that you're not charging your employees both to the PPP loan and to the other grants that you've received from the federal government. The federal government has also asked that organizations try to use some other funding resources, whether it be from donors or working with their landlords or other ways to try to decrease the amount of expenditures that they're having for their operational costs, and to document that they have tried to do this effort to reduce their expenses during the current period. In regards to salaries and benefits, you can charge those to the federal funds. It just needs to be made sure that it is consistent with what your current awards are. And the last item, and we are still waiting for more information for what this actually means, but on your schedule of expenditures for federal awards, there will be a requirement that you separate the funds that are coming from sources that are noted from a COVID-19 Emergency Act type of funding on the face of the CFA. Additionally, if you receive federal funding and your financial statements are usually due to the Federal Audit Clearinghouse 9 months after year end, there was some extensions. The first round of extensions were significant, a 6-month period. Then there was another round of extensions that was a 3-month period. And this was really for those organizations that were impacted in the March timeframe, where maybe their audit was occurring or they were trying to do their year end. And those are the ones for which they've gotten the extensions. Anybody who has a fiscal year end that starts in January 31st, 2020 to June 30th, 2020, and moving forward, they have clarified that you will not be receiving an extension. So if you're a June 30 year end, your financial statements to the Federal Audit Clearinghouse are still due March 31st, which is the normal 9-month period. The other item that I want to highlight is the compliance supplement usually comes out in late June or early July. It is now July 23rd, and that supplement is not yet available. So we're still waiting for guidance on how the single audits are going to be performed under the compliance guidance. But we have been told that there's going to be a second part that is specifically just for the COVID-19 programs. That's expected in the late summer or early fall. Based on the fact that the current Part 1 supplement that was expected in early July is not yet available, I don't know when that Part 2 will be coming out when they say early fall. The impact of that is for auditors, we're still waiting for what that means in testing our major programs, whether or not you receive funding from the COVID-19 related grants, how that's going to impact our major program testing. So for organizations, it's important to make sure that you've communicated to funders or other constituents possible delays in getting your financial statements issued. For example, there may be more instances for which the financial statements will be separate from the single audit so that you can have your loan covenants completed. And as we've mentioned, we do have some resource pages available. We do have the BPM COVID page, and the AICPA does have a toolkit that is available for public use on their website.
Next up are some additional tax updates. So now we're moving on past the COVID topics into more general tax and accounting topics. We will continue trying to respond to your questions as they come in. Please continue to submit them, and we'll try to address them now or if need be after the event.
So as we move into other tax updates, that's where we have the fluid situation again, because there are a couple of updates which came out. One is for executive compensation and one for UBIT, but guidance is not final. For UBIT, last week, I believe the IRS said they might change some proposed regulations. For the compensation, the proposed regulations were issued in June. It's open to comments, so if you feel like you want to read it, submit a comment, you still have time. It's open to comments until August 10. So let's do a refresher for compensation. Compensation is pretty important for nonprofit organizations. Compensation for your officers, directors, key employees, highest compensated employees is on your Form 990 and Form 990 PF, which means it's open to public disclosure. Anybody can see it. Anybody can pull it from internet and see how much people are making. And sometimes people are still surprised it's open to public disclosure. And people like to see other people's salary, so they might pull it and look at it. There is a threshold, dollar threshold for compensation for highest compensated employees, which is 100,000 per calendar year. And it's based on a W-2, it's reportable compensation. And for key employees, it's 150,000. And for key employees, you also have some of this responsibilities test. What is important to remember? If your organization provides some unusual benefits, not just medical insurance, dental insurance, vision insurance, you might need to see if those benefits are taxable. And if those benefits are taxable, you might alert your payroll provider if you're not doing payroll in-house, or you alert your payroll department. Because sometimes people will not pick up, even if organization submits information, payroll provider might overlook it. Compensation has to be reasonable, and it mostly relates to decision makers, to trustees, if you're compensating your trustees, to your CEO, CFO, Chief Administrative Officer. How you determine reasonable compensation? One way, you look at other 990s, you do a compensation study. So a consultant will gather the data and see where is your compensation. Is it in a range of reasonable compensation? Form 990 Schedule G asks us to report various types of compensation. And next slide, please. So if you just look at Schedule J, you can see question number 1 asks, does anybody who you disclosed on 990 travel first class? And some people travel first class, and then you just explain it. Then also the last question on the right, it says, do you have personal services provided, such as maid, chef? I haven't seen it personally, and I'm pretty sure not many organizations will provide such services, but 990 asks. If they ask, I assume I have seen the maids, chefs, chauffeurs. There's also if you provide any payments for personal residence, housing allowance, you have to disclose that. If you do travel for companions, you have to disclose that. So your Schedule J has to spell out, if you have to fill out Schedule J, various types of compensation. In December of in December of 2017, we got a new law which says if you're compensating anybody over $1 million, or you have excess parachute payments, the excess amount over $1 million, or excess parachute payment, which is 3 times of your base amount, salary or compensation, have to be taxed. It has to be taxed at 21%. That's what we heard in December, and the notice came out in 2018, and when we read the notice, it wasn't clear who is gonna be hit with this tax. Because notice didn't do a good job saying, okay, maybe you have not one organization, maybe you have a very complex structure. You have tax-exempt organization, several taxable subsidiaries, maybe related partnership, maybe another tax-exempt organization related to you. And notice actually brought everything in. So even if organization does not compensate somebody over $1 million, you can still be subject to that tax if somebody pays, you and related organization pay over 1 million, you have excess parachute payments. Next slide, please. In June of this year, the proposed regulation came out, which actually clarified some of the questions we had, because one of the questions when I read the notice was, okay, what if you have a corporation, and corporation pays an individual over $2 million, for example, and that individual works on a related foundation. Does it mean we have to bring that compensation and tax it at 21%? And in the notice, you couldn't say if it applies or not. But regulations came out and they said, okay, we give you exceptions. So first you need to look, are you an organization to which this rule applies? Then you have to figure out, is the organization or related organization as a common law employer? Why it's important? Because if you have a payroll provider, payroll agent, common paymaster, which makes payments to employees, it doesn't mean you can avoid the liability. If you have several organizations in your structure, you might have one organization which doesn't have common law employees, but others do. And also, if you have officers, our officers are considered to be statutory employees. So you need to look, does it apply here? Next slide. The control is not defined. It's on a slide what is considered to be a related organization. The control is not defined. A proposed regulation said we're going to take 990 approach, but it's not final. It might change. So when we get the final regulations, we don't know what we're going to see. Next slide. Which was a good news for a proposed regulation? We got a volunteer exception. Before, when you read the notice, even if the people were not compensated, but were compensated by related organization, you kind of read it, okay, I need to bring this compensation in. Now, in the proposed regulation, IRS said, okay, we're going to give you a volunteer exception. And we're also going to say that if individual performs services as independent contractors, it's not subject. Next slide, please. So the main thing to know for volunteer exception is, if somebody works less than 100 hours for the organization, you automatically get limited hours exception. Then we have 10% rule. And again, you need to look at all the organizations involved. So if you want to use 10% rule, you have to actually document how much employee works or individual works everywhere, and then look if it's less than 10% of total hours. So record keeping is very important. But the good news is, when I gave the example that somebody from the corporation who makes over $2 million volunteers for corporate foundation, now that person compensation will not be brought in if this person does not work than more than 10% for the foundation. So if you have a situation like that, maybe you limit people and say, okay, you can work for 3% of your time, 5% of your time, but don't go over. Don't volunteer too much. It sounds a little bit counterproductive, but you want to be safe. Next slide, please. Also, what is important, because another question was, if you have a private foundation and private foundation controls, like family controlled, one family controls a private foundation, and they also have related businesses they control. Before, when we read the notice, it sounded like we have to pull this compensation in. Now, if you don't compensate those board members and they don't work too much, you don't need to pull the compensation. So how do you look at that set of rules? First of all, look at your compensation, severance, deferred compensation agreements, because even if you don't have 1 million compensation, but you have deferred compensation, you might get in that 1 million territory. Consider modifying the separation agreements, saying that, okay, nobody get excess parachute payments. Not sure if it's possible practically. Look at your whole structure and see if you get multiple streams of compensation going through. And maybe don't compensate board members, especially if they work too much on your organization and they get compensation from related organizations. But what happens if you still have 1 million compensation? Maybe it's from your organization, maybe it's from all the organizations. You have to pay tax. You have to file Form 4720. It's due at the time when your tax return is due, your 990 or 990 PF. It can be extended. You don't need to make estimated payments, but you have to pay the extension payment. So if you have a situation like that, reach out to your tax advisor, reach out to us, and we can give you more information, because you actually need to go through and see who is involved. Is it gonna fall into category of compensation from related organization, and what do I do? And remember, this is not final guidance. So next time when we get the guidance, it could be something else. I'm going to touch very briefly on UBTIs. Probably doesn't apply to all of you. And for people, organization to which it applies, they already know that in 2017, the law was changed. And before we could aggregate all the activities to one income or loss, but now we have to look to each separate business activity to determine if it's a loss, if it's income, and they can offset each other. That's what silos mean. The regulation still not final, might change again. Last year we had notice, and notice said you have to use 6-digit code. This year they said you have to use 2-digit code. And once you pick your digit code, you have to stick with that pretty much. You cannot use the code which is related to your exempt function. And to change it, you kind of need to show that it was picked in error, and actually different code will better describe what you're doing. And I put a link here. You can go and see what codes are available. But for example, it's code 21 is for mining. Code 22 is for utilities. Code 54, professional, scientific, technical services. Next slide, please. We got more guidance. What could be grouped in one silo? And for the organization which have numerous partnership interest, if your partnership interest is 2% or less, and your capital interest is 2% or less, and there is a control test if the ownership is 20% or less, and the nonprofit does not control the partnership and doesn't have influence over the partnership, you can group it in one silo. But if you have a partnership where your ownership, for example, 70%, you have to look through the partnership activity if it generates unrelated business income to determine if you have to silo those activities. And it could be very problematic because you need to get information from the partnership. And your partnership may be invested in 3, 4, 5 layers of partnership. At some point, you're going to hit this threshold where you can aggregate activities. So we will hope that partnership will step up and they will give more information for unrelated business income. There is a transition rule in place. So if you bought partnership interest before August 21, 2018, you can use this transition rule. It's in place now. We don't know if it's going to be in place later. Some good news is that income from debt finance property can be included in the same silo as other investments. Next slide, please. If an organization has an interest in S corporation, you use the same rule. If it's less than 2%, you aggregate them. If it's more, then no. Also, the CARES Act gave us new NOL rules because in 2017, we were told that no more NOL carryback. You have to separate NOLs. Whatever happened before 2018, you can carry forward 100%, then you can carry forward whatever happened after 80%. Also, whatever happened after 2017, you had to separate by silo. So you cannot offset. You have several activities, advertising, investment, selling t-shirts. You cannot offset income from each other, and NOLs have to be carried forward accordingly. CARES Act said, okay, we're gonna give you 5 years carryback. So you can carry back your 2018, 2019, 2020 NOL 5 years. As far as we have guidance, it says if you carry it back where you don't have silos, you don't need to follow silos. If you carry back it to the years where you had silos, you have to follow silos. Of course, California doesn't confirm. So California has its own rules, and they're looking, I think, into suspending 2020 NOL, but it's not final yet. So again, to repeat, investment activities you can put in one bucket. Rules for separate trade or business does not apply. You don't need to find the code. So qualifying partnership interest where you have de minimis ownership or you don't have control of 20%. Qualifying S corporation interest and debt finance property, you can group it all together. If the organization has supporting organization and control entities and you have ownership in the same partnership, you have to aggregate the interest. Which is good news is you don't have to pool into interest owned by disqualified persons. So if somebody on your board owns the same partnership, you don't have to count that. So we're waiting for more guidance. Last week, I believe, IRS said they're working on rules. They might change. We don't really know what to apply. One message is it's became much more complicated. It takes much more time. You have to go through communication with your investment partnerships, maybe. And if you have separate activities, business activities or trader businesses, you need to track them separately.
So we just wanted to put a reminder in here that if your organization reimburses expenses of its employees or officers or anybody in there directly related to business, you need to make sure you have an accountable plan. And it became more important after the Taxpayer Cuts and Jobs Act. So post 2017, a lot of organizations, if your employees were paying some expenses and you're a nonprofit organization with a minimal budget, they might have just paid those expenses and taken the deduction on their personal return as employee business expenses. And there is a deduction available to individuals for expenses that they spend relating to their employment if their employer doesn't reimburse them. And that deduction disappeared after 2017. And so if your organization, if it's a valid business expense, they need to have an accountable plan set up so that they can reimburse their employees for those expenses. Next slide. So in order for the expense to be allowable, the expense has to have a business connection to your organization, and the substantiation must occur in a reasonable period of time. And if you have a plan where you give an employee funds before, let's say for a trip or something that they're going to a conference, which isn't happening right now, but hopefully we can travel again in the future, they must return to the employer any money that wasn't spent properly into the plan. So substantiation generally means that, a detailed receipt that shows what the money was spent on, and then documentation of the business purpose. But the rules are very detailed, but in general, you want to make sure that you have proper documentation. Next slide. So, and this is a good segue to Melodie's next segment, but we just wanted to put a reminder in here that gifts in kind have a different treatment for tax and GAAP in some areas. So if your organization has contributed services, including advertising, or you do auction items and you have people contribute things like vacation home usage or space for an event, or skilled services, those are the types of things that may meet the threshold for recording as income and expense on the GAAP side, but for tax, we have to reverse those out. So it's important for you to kind of track those types of expenses so that we can take them out for tax purposes. There's really a net effect because you remove the income and the expense, but they're just not reportable for tax purposes. Gifts, in-kind gifts of furniture and equipment and clothing and supplies and essentially tangible goods are reportable for GAAP and tax.
Okay, great. So let's jump into the updates to the gift in kind standard. So again, this is a proposed standard. We initially saw the first draft come out in February of 2020. We saw a clarification come out in June 10 that really just said the scope of this project is really limited to those non-financial assets that are recognized by nonprofit entities. We're expecting a final draft Q3, which means sometime Q4 into 2021 we'll get that issued ASU. And we're expecting that it will be applicable for periods beginning after June 15th, 2021. So that would be our June 30th, 2022 fiscal periods or calendar year 2022. So when we look at what the background is, really what this is just to address maybe a lack of transparency about organizations that really have material gifts in kind or multiple different kinds of gifts in kind, those non-financial assets. So these would be if they're getting contributions of fixed assets, land, building equipment, utilities, food, clothing, pharmaceuticals is a big part of this conversation, any intangibles or contributed services. So looking at what this requires, we go on to the next slide. It's going to be looking at our presentation. So a number of my organizations that I work with already had a separate line for gifts in kind contributions, but really calling out those contributed non-financial assets as a separate line of your statement of activities, and then giving really more disclosure requirements, disaggregation if you're receiving multiple kinds of non-financial assets, what the policy is for monetizing or utilizing those contributed non-financial assets, and if there's any donor restrictions, how you're valuing them, and then what market is being used to derive a fair value. So in this example, we see what we would anticipate a footnote to look like, where you would see, in this case, we would have in 2009, $1 million of contributed goods, and that's coming from a $550,000 building, other goods, medical supplies, those pharmaceuticals calling out. And then if you go to the next slide, so that's the quantitative piece, really looking at the qualitative piece as well, getting into your first paragraph, calling out the kinds of contributed items, whether or not you are identifying any donor restrictions on those items. For the building, in this case, we're saying that it's being used for general and administrative activities, so it's not a program building. And then they're valuing it using the principal market, the metropolitan area that that building is in. And then for items that are being used in programs, so that third paragraph calling out items used in programs, if there was any restriction, and again, how they're being valued. So you can see what the purpose of this ASU when it is finalized is really just to give the reader more understanding of when your organization is relying on non-financial contributions for their operations. And then the next presentation of it is another example of how you potentially could present it. This reminds me of that fair value level 3 when you would have to call out how things are being valued. This is another example of how you might want to go about presenting it. And it depends on how you think your readers could best read that information. Going into the next ASU, 2020-05 came out in response to COVID, and really it's a delay. So looking at ASC 606, that's our revenue recognition topic. it's requiring or delaying the requirement into next year. So for my 1231 organizations who have already issued this year, you've probably already gone through the adoption period. This may be for my 630s who haven't yet. A couple of pointers, and this is my opinion. Talk to your audit committee on your board before making this decision to postpone. Since you should have been adopting as of the first day of your fiscal year, you're kind of saying that you didn't. But if you were in the process of adopting, it is impactful, and because of COVID, you were unable to kind of keep up with the requirement. This kind of allows you to push out for a year. And then also, I'm convinced they're always going to find a reason to push out leases. We have pushed out leases yet another year, so now it's going to be fiscal years beginning after December 15th, 2021. So it's going to be your calendar year 2022 or your June 30th, 2023 now. Or sorry, 2022. So if we go on to the next slide, ASU 2018-13, you may have seen it last year. I think we talked about it during our ANA update. So we want to just really quickly address that this is coming out. It is a removal, modification, or addition, but only for public entities. So if you have a level fair value level 1, 2, and 3 hierarchy, you want to just be familiar that there are some changes. It is not required until next year. So for this year, just if you're adopting early, because it is removing a number of disclosures or modifying, and then again, the additions are going to be really based on your public entities, so it probably does not apply for you. So like I said, we're going to jump through these revisiting slides. I think the biggest thing that I want to call out just for ASU 2014-09, this is our topic 606. Keep in mind for organizations that are doing special events revenue or may have sponsorship agreements or membership agreements if you're a membership organization, you most likely will have an aspect of this that will fall under 606. So you want to make sure that you're keeping in mind allocating the portion that's a contribution and the portion that's your earned revenue. And also keep in mind any earned revenue, unless it falls under leases or anything else, is really going to come through in your disclosures. So you want to make sure your policies and disclosures are getting updated to reflect it. Our contract assets and contract liabilities, since this is new, potentially for some organizations, I'm thinking if you're a membership organization, you're going to end up with your deferred revenue. For membership organizations, that's going to be a contract liability. So you want to make sure you're keeping up to date with what the disclosure requirements are under ASC 606. This also comes up for my high schools and their tuition recognition. So just be aware of contract assets liabilities. I've also seen impact on the next slide is talking about principal versus agent. Oh, sorry, go one more. Principal versus agent transactions. One of the things I found in my audits was clients hadn't necessarily thought through agreements where they were acting as an agent and they were actually somebody else was completing the work. So be aware if you're not a middleman, but you're acting as an agent for an entity, that has impacts on how you're recognizing your revenue. And then 2018-08, this is required this year. Again, your two main items, reciprocal versus non-reciprocal. If you're getting a grant or getting a contribution and the resource provider is not the general public, but you're looking at if there's a direct benefit in determining if it's reciprocal or non-reciprocal. So an indirect benefit, so if a general public gets a benefit but not the resource provider, then it would be non-reciprocal, falls under your contribution. We have some great examples in here. And then the second issue is really conditional versus unconditional. And you can see here some of the disclosure requirements that comes through that. For the conditional and unconditional, really look at those defined barriers. If you're looking at your grants or your contributions coming in and you're hitting something where it's requiring you to do a certain number of things, or they have the right to revoke the grant or refund the money until you accomplish something, that's indication there's a barrier there. So you just want to be aware of these clarifications that were provided in 2018-08.